Hi, everybody. My name is Forrest Cragton, and I am a former investment banker and private equity investor. I got my education in business economics and accounting, and then I went on to get my master's in business administration. I've served as the chief financial officer for multiple organizations, and I'm here today to talk to you about accounts receivable. Accounts receivable is important to a small business owner because it's how you track where the money is that you are owed by your customers. Many small businesses maybe don't track this, or they use other payment methods where they don't really know where their invoicing is going or what money is owed to them by their clients. And it's really important just to have a tracking mechanism so you can follow up with your customers when you're owed money. Well, accounts receivable is one methodology that businesses can use to track money that is owed to them. It develops exclusively really when businesses sell on account or on credit. Other ways that businesses could sell is either by prepayment, where a customer pays you before you ever do anything or you ever ship a product, or they could also pay you at time of service. So, example, if you were to go to the salon and get a haircut, that's oftentimes a pay at time of service. You're paid immediately after the service has been rendered. A prepayment would be something like a magazine subscription or other subscription services where a customer is paying you in advance for something you have yet to provide to them. Those would be ways that you would avoid accounts receivable because you're paid really immediately or before you ever do anything. Accounts receivable develops when you sell on credit or account, and a customer is going to pay you at some time in the future after you've rendered the service or the product. Now, it's important to track this information so you know what's owed to you and how long that money has been outstanding. And it's also really important to kind of go over this from the standpoint of what customers pay you on a timely basis and what customers maybe don't. Ultimately, you want your customers to pay you on time and in full. You deserve to get paid for the work that you do or the products that you ship. It's important to track that. You decide what on time means to you. Maybe on time means that you're paid at time of service. Maybe you're the type of business or in the type of industry where it's more customary to pay on credit or pay on terms. And maybe that's in the sort of situation where you'll be paid 30 days down the line for services that you've already provided. Well, let's talk a little bit about payment terms. Payment terms are simply the terms that you and your customer agree to that they will pay the invoice or the monies owed to you. Those terms can really be anything you want them to be. There's some general, more common terms that are out there, and we'll go over the more common ones today. But really, it boils down to what you and your customer agree to. You can make your terms whatever you want them to be. But some of the more common term types are something that you may see on invoicing, and you may see something like net 30 days. Now, what does that mean? Now, net 30 days basically means that by the time that you produce an invoice and you send it to your customer then receives the invoice, they have 30 days to pay you from the time of receipt. Now, why would you agree to this? So, this could be industry standard practice in the industry that you operate in. Maybe your customer has negotiated that with you and said, hey, I really want to do business with you, but I need to pay you in 30 days. And you want to do business with this customer, they're a great customer, and you're going to agree to those terms. You can set those term dates at any date interval you want. You can say net 10 days, net 15 days, net 30 days, net 45 days, net 60 days. You make up those terms, and that's an agreement between you and your customer. It has to do with how quickly you want to get paid. Now, in your accounting software, when you set up your accounts receivable program, it's going to be very important that you understand what terms you're asking for and what dates are critically important on your invoicing and that you've agreed to with your customer. So, for example, when you say, I want to be paid in 30 days, 30 days from what? What do you have in your mind and what is your customer thinking on the other side? Is it 30 days from the date of service? Is it 30 days from the time that you produce the invoice? Is it 30 days from when the customer receives the invoice? All of those dates can be very different. And if you don't have agreement on what date you're all talking about, that creates confusion with your client and that creates uncertainty in your cash flow. You can also have due upon receipt. So when the customer receives the invoice, that's when the payment's due. And that can speed up your cash flows a bit. One other common type of payment terms is end of month. This one is where a payment's due from your client at the end of the month. And that really determines on when you invoice them. So if you invoice them, let's say in April, then the payment for them is due in April. Your payment terms can be different for your clients. So let's say, for example, you have a client that doesn't pay you on a timely basis. All the rest of your clients are on net 30-day terms. You can change them to a prepaid. Let's say Jim doesn't pay his bills on time. You may decide to collect payment up front before you render service or deliver a product. You have a lot of flexibility here. So customize your AR, accounts receivable, and your payment terms to what suits your business and your customers. So let's talk a little bit about an aging report. What is aging and why should you care about it? Aging is simply the amount of time that your invoices are outstanding. That means that they haven't yet been paid. You're owed this money and you need to chase it down and collect it. So let's find out through this aging report how long it has been outstanding. An aging report will be bucketed. So when you produce this report, you should see various categories. The first one likely is going to be current. That means that those invoices are issued, but they're not yet due. They're current. Your customer's not late. And that bucket is a good bucket. That's great. Your customers aren't late yet. That's fine. You don't really need to worry about it. The next bucket is typically a 30-day bucket. And what that will indicate is invoices that are aged over 30 days. This assumes that you set your terms to be due at 30 days. You can customize, again, what your terms are. I'm going to use 30 days as an example because that's fairly standard in a lot of businesses and industries. At 30 days, that means your invoice is now aged over 30 days. Now, invoicing, unlike wine, does not get better with age. You want to collect it as fast as possible. So in your 30-day bucket, that's when you want to start following up with your customers. You'll also see other buckets like 60 days, 90 days, and maybe even 120 days plus. These are buckets that just show you how old this invoice is. The older it is, the more of a concern it is for your business and collecting it. Now let's talk about how you might use some of these buckets. Now your 120-day bucket is sort of a very dangerous bucket. If you can imagine a customer only pays you once every 120 days, that means they are only paying you 3 times in the calendar year. That's very infrequent payments. And unless that is your industry standard or something that fits with your business, that's usually a bucket you want to avoid. Now, let me talk about an example, a hypothetical example. Let's say you own a cleaning business and your cleaning crew goes and cleans an office every night. And they service the office every night. They do all the cleaning services that you've contracted for. And your cleaning crew expects to get paid in a timely manner. Maybe you pay them every week. Maybe you pay them every 2 weeks. Well, if your customer isn't paying you on time and you had 30-day terms with them and they let it sit outstanding for 60 days plus, you could be paying your crew up to 8 times before you collect one payment for your customer. So can you afford that? Can you afford to pay your crew and not collect from your customer? That's what your aging report will help you see. And if you see that invoice sitting outstanding in those various buckets, that's basically what's happening. Collections, sometimes that can get a little bit of a bad name. I'm not talking about collections where you send somebody off to a collection agency. That's really the last step in the process. Collections is simply you trying to collect the money that you're owed. So your aging report, which is coming out of your accounts receivable module in your accounting software, that tells you how aged your invoices are. And you can set parameters for when you want to start following up with your customers. That's what I mean by collections. You're trying to collect the money you're owed. So as you work on your collections, it can be something as simple as at the 30-day mark, for example, I want to send a reminder invoice. Maybe they missed it. Maybe it got buried in their inbox. Maybe they just didn't see it, or it got stuck in their payment process and they haven't processed it through. Let's send a follow-up invoice. Well, you might do that at 30 days and they still don't pay you. So another 30 days goes by. Maybe you want another process there where you send an email with an attached invoice to it to the primary contact at your customer. Eventually, you may need to follow up with a phone call or something of a more personal touch. I know this can be tedious. I know this isn't necessarily the fun part of business or what you got into business to do, but unfortunately it's something that every business faces, no matter the size. And so getting on top of your collections and being willing to follow up with your customers helps you keep your books clean, helps keep the cash flowing into the business, and ultimately creates better relationships between you and your clients. So some great tips for collections. It doesn't have to be this fraught interaction where you're worried about your client relationship. Really, you're just trying to collect the money that you're owed. Collection can start with the follow-up invoicing and then proceed to a personal conversation. Now, a great way that I've dealt with this in my past and in some of the businesses that I've been involved with is having a conversation with your point of contact at your client and saying, "Hey, we really love your business. We thank you for your business. It's a great opportunity to reach out and have that personal touch with your client again." It doesn't have to be a fraught conversation. You can say, "Hey, we've got this outstanding invoice, and it's been sitting outstanding for 30 days, and it's sort of impacting my business and my ability to continue to do the good work that you enjoy from us. So I'd love to get that invoice paid. Oh, and by the way, this other project that we have coming up for you, or we look forward to winning this new business, it can be also a selling opportunity. So you can reach out to your client. You're asking for the money for the work you've already done. You can touch that relationship again, restore that relationship, and then ask for future business as well. Now, it doesn't have to be antagonistic. It doesn't have to be anything where the client's doing something personally to you. Sometimes that conversation will reveal that they just missed it. Oh, I'm so sorry. I've been slammed. That invoice fell down in my inbox. I'll get that processed right away. Um, your aging report and your AR is what you use as the early warning sign to see these things develop. And your methodology of follow-up will be determined by you and your business and your industry. But again, it can be a way just to have a conversation with your client. One thing that you can get out of your accounts receivable and potentially out of your aging report and after your collections efforts can be coming to the tough decision to potentially fire a customer. You're in the business of providing a service or a product, and your customer should be paying you for that. And if they refuse to or can't pay you for the service or product you provided, eventually you may have to make the difficult decision to no longer do business with them. It is critically important that you get paid for what you do because you are incurring costs, whether it's your time, your team's time, or actual inputs that go into the product that you're producing. You are spending money to service your client. And if you don't collect from them, they're not only getting it from free from you, they're actually costing you money. Unfortunately, I have had to fire customers in the past. And oftentimes my accounts receivable team would come to me and let me know that a customer wasn't paying. We'd use all tools at our disposal, whether it was our account manager to follow up. I would personally follow up with the client. I would talk to them about the situation. I would talk to them about the money that was owed to us. And unfortunately, there's sometimes we've had to decide not to do business with the client anymore. We've had some clients that were in financial distress, and we didn't know about it until our aging started to get a little bit older. That was a good warning sign. We reached out to the client. Turns out they didn't have money to pay us. And so we really couldn't do business with them. I have had situations where clients have tried to make whole and they've issued small payments, like on an installment plan to try and get out from that debt. Other clients have said, look, I just don't have the money to pay you. And that's been a tough conversation where we as the business would incur a write-off. And that's a direct expense that hurts our profitability. The conversation with the client is, look, I'm sorry it went this way. I hope that you get back on your feet. If you do, and you still want to use us for product, service, whatever we do for you, we'd love to have you back. The payment terms will be different. We would likely put them on prepaid. We absolutely would put them on prepaid. And then we can move forward. But we still want their business. We would just change the terms and want to collect for what was owed to us. Sometimes you're going to be in the tough decision where a client is consistently paying you late, habitually paying you late. They pay you, but they stretch you out and you're constantly following up and you're having to chase them and you're having to call them, and it's just Groundhog Day. When do you have to come to the tough decision to maybe let that client go? Now, I can't give you a direct answer for your business. You'll have to determine that for yourself. But some things that you can utilize to determine whether or not it makes sense to not work with this client anymore. Maybe they're too small. Maybe they're a small client that really doesn't move the needle on your business very much, and it's just not worth the hassle. That could be one mechanism you use. If your collection efforts and your follow-up with this client are taking you away from higher and better uses of your time for your business, such as selling, growing, innovating, and that's dragging you down, and you say, you know what, I'm not really making enough profit for this to be worth it. My time is worth more than this. That could be an opportunity for you to look at that client and be like, you know what, I really don't want to work with them anymore if they're not going to pay me on time. And it's important as you go through this process to remember that this is business. It's very difficult because you pour your heart and soul into your business. You blood, sweat, and tears into your business. And to step back and say, you know what, it's just business. These are the terms. We've agreed to them. They're not abiding by them. I don't want to work with them anymore. That's okay. And you can decide to do that. Really, it boils down to the profitability and is this client worth the headache? That's something only you can decide. So over the course of my career, I've looked at a number of businesses, both to sell and to acquire. So if you're looking to do either of those things, either acquire businesses or sell your business, accounts receivable is critically important. And the reason it's important is because that's how quickly you get cash in the door. And it helps people determine whether or not your revenue is real. If you sell a product, but you never collect the cash, that actually harms your business. And it's not real revenue. It's not revenue that we can say, oh, look at this great sales number if we never collect it. So this is the whole life cycle of that revenue to cash. And you need to collect that money. So if you were to run an aging report, let's say for your business, and it shows everything's aged 120 days plus, the buyer's going to be like, I'm never going to get that money. And they don't have a relationship with their clients or an expectation set with their clients that they're going to get paid in a timely manner. That's not a great thing to see. On the other side, if you're an acquirer and you see that in another business, you wouldn't want to step into that mess either. Now, let's say you're a small business owner who someday looks to sell your business. You can use this report to show well to potential buyers. You can show your buyers, your potential buyers, that you collect your money on time. You can show them that your revenue is real. You sell a product, you collect the cash. You do it quickly. So through this process, through your collections, through your aging report, you can show things in your current bucket, your 30-day bucket. There really isn't a lot in your 60-day bucket, and maybe just a little smattering in 90 days. And you're all over that. You have a story for each one of those invoices. Oh, this 90-day one, the client didn't like that particular product I sent them, and we're working on a credit. Or that 90-day one, the client's on a payment plan. You can tell them exactly, you're on top of your business. You're on top of your books. And that shows a potential buyer that you've run your business well, that they're potentially buying a business that has good paying customers. And that's part of what they want. That's part of what they're buying. They want a customer base that pays on time and in full, just like you do. A well-managed accounts receivable gives you great cash turn, meaning you sell a product or service, you provide the product or service, and then you get that money in the door, the actual cash. Cash is critically important because without that, it's just air, it's ethereal, and you're actually incurring real expenses. So clean AR, good collections, helps you improve that cash cycle. So in summary, we've talked about accounts receivable, we've talked about aging, we've talked about collections, we've talked about terms, we've talked about firing customers. That's a lot to cover. But why is this so important to your business? Accounts receivable is the money that you're owed. And the aging report that you get out of your accounting software just tells you how long that's been progressing through time. These are critical things to watch in your business. It helps keep your books clean. If you need additional help here, you can reach out to Gutsy Money and they can help you get your accounts receivable in order and help get that cash flowing in the door.